Hello and good morning, listeners. Welcome back to Almus Market Mornings, your daily dose of global financial updates. I'm your host, Swaraj Rajagopal, and we have got you covered on everything from currency shifts to pivotal central bank decisions and important speeches. Plus, you'll gain expert analysis on macroeconomic data that's shaping the market narrative right now. Join us for this episode and navigate the markets with confidence. There's no shortage of developments this week spanning data, politics, and geopolitics. In the US, President elect Trump's moves continue to shape markets. Last week it was Mr. Besant's appointment. This weekend it was talk of potential tariffs on BRICS nations if they reduce reliance on the US dollar. On the data front, India's economy slumped to a 7 quarter low of 5.4% growth in Q2, falling well below expectations and the RBI's 7% projection, pressuring the rupee and lowering bond yields. In Europe, political uncertainty grows as France faces internal disputes over its budget, putting the stability of its coalition government in question. Meanwhile, tensions in Syria have escalated, with Turkish backed rebels taking control of Aleppo, forcing the Syrian president to reportedly flee to Moscow. Good morning, JK. With so many moving pieces globally, how are you making sense of it all?
Good morning, Swaraj. Yeah, I think market had probably, if anyone had thought, Trump 2.0 is going to be different and he's going to be like much more circumspect in his, utterances. I think last week has proved them wrong. Because there have been quite a few tweets, which has suddenly put a lot of uncertainty into the markets, and now people wonder what to expect next. First, it was the tweet about tariff on Mexico, Canada, and then, of course, the weekend tweet on BRICS nations, 100% tariff and all that. We don't know how far they are all tenable and whether they are being used as a negotiating tool. But so far, we haven't seen any reaction from, at least from the BRICS nations, on this tweet, and we'll have to. I mean, it's not something that we can actually take a stand on whether it can stand or not. But I think one thing it makes very clear is Trump is not going to be different as far as communicating his thoughts, and it's going to be the same, more or less. Of course, we'll see what happens when his team starts into action next month when they are taking office. Yes, otherwise also, we had political developments in Europe, not good for the euro. Again, euro was trying to recover well towards 1.06 plus, which was my view as well. But then the weekend political developments in France, where the budget is reaching a stalemate, and there is a possibility that no confidence motion will be placed in the parliament, leading to another bout of uncertainty. French yields are, through the roof, and it's really clear indication that the money market there is under stress. Germany already had a political issue, and we have seen retail sales from Germany last week also coming much lower than expected. It's continuing with the series of negative data from the big nation, and of course the inflation from eurozone was slightly higher on the year-on-year basis, leading some officials to say that 0.5% cut in December is not justified. But then the month-on-month number is actually much lower. But overall, I feel Europe will go for a measured move of 0.25% cut, and they'll continue to cut so long as the economy is not responding or picking up. But I think it takes a long time, because it's not just a cyclical issue; it's also the structural and the political issue in Europe that will keep the euro currency subdued. On the other currencies, the yen was the big mover, till last Friday, because the Tokyo inflation leading many to think that the overall inflation in the country is going to be higher. Therefore, yen strengthened, expecting a move in December. Their meeting follows immediately after Fed meeting. But then even Mr. Ueda spoke in the weekend to Nikkei newspaper, where he's stated to be, observing that data are falling in place for the next move. He doesn't say December or January, but then definitely he's recognizing the fact that the inflation is moving to target, and wage negotiations coming up in the country would be decisive. So the reason we are focusing so much on yen and the yen interest rate is because it creates a lot of volatility across the markets, including India. So that is something that we cannot ignore. Also, oil has been rangy, but I think there is a lot of concern about oil prices coming off, because US will be producing a lot of oil to keep the inflation down. So nothing really to enthuse even as we move into the new month. But there are, of course, big events lined up. We have the host of job market data from US, culminating with non-farm payroll on Friday, expected to be higher at 180,000. You remember last month it was just 12,000, but affected by the port strike and the storms in the US, also strike in the Boeing. But we'll have to see if it comes anywhere below 150. It can be slightly negative for the dollar. As of now, what we are seeing is that markets are looking at 65% chances of 0.25% cut by the Fed. They are also looking at 27% chance that ECB might ease by 0.5%, but 60% probability of 0.25 cut. Also, market is looking at over 30% probability of Japan actually hiking rate in their meeting coming up. So there's a lot of focus on the upcoming monetary policies, non-farm payroll data from the US as well. Still, we have a lot of time to run for the new administration to take over as well. Yes, sir, there was quite a shocking news about GDP in India. Q2 falling to 5.4%, which was lower than the most pessimistic forecasts as well. I think no forecast was below 6%. But then, the market is also quickly coming to the some sort of a thinking that this may not become a falling trend, because this was affected by a big slump in the manufacturing and also urban consumption. But going forward, expectation is that the rural consumption will pick up. Kharif and Rabi crops are reportedly good, and government spending will pick up also in the second half of the year. These are the expectations. But all said, I think we are, 7+% growth seems to be out of the realms of expectations from most of the analysts, and I think I personally feel that we'll be somewhere between 6 and 6.5% growth rate in the coming quarters as well. So in this context, I'm very keenly looking forward to RBI's meeting, upcoming meeting, where their projection on GDP and inflation will be very closely looked at, because they have been sticking on to 7.2% full year growth for 24-25 and inflation at 4.5%. Both of them have been, way off. The real numbers have actually been, both of them have been off the mark. So how much they revise down the inflation and how much they revise down the GDP projection will be very important as far as Indian markets are concerned. Inflation, of course, if they do see inflation coming off, then they might have a dovish hold in the meeting, and GDP projection will obviously be a guide for market to see how we perform in the stock market also. Whether that will also lead to some sort of a dovish indication on the interest rates. Perhaps a February cut is what most people are now expecting. I feel it's not just the interest rates, even RBI's statements and the governor's statements might actually give an indication as to the rupee as well, because rupee has now broken 84.50, which I thought was a strong resistance that will hold, but then GDP number was too weak to ignore. So having broken 84.50, it's very difficult to see it coming below that, unless there is a bigger intervention. But then we have seen even the reserves fall for the eighth consecutive week, from a high of 704 to 656 billion. And this is apart from the forward maturities, where the RBI is running a short position. So I think if the dollar starts to strengthen overseas in a bigger way, I think rupees move also can be much faster. Otherwise, it can continue to be in a controlled way, at least for now. Thank you.
Thank you, JK, and the quite a lot of developments that are going on. Of course, President-elect Trump's tweets are keeping the markets on edge. Earlier, it was on Canada and Mexico, which resulted in both these countries taking some action. Now it's on BRICS. There's, of course, the political developments in Euro, which is keeping the Euro weaker. The data lined up this week is job market indicators for the US will be released, including the non-farm payrolls. For the rupee, of course, a break of 84.50 has been seen, and the markets will be keenly watching whether or not it sustains today. The reserves have also fallen for the eighth consecutive week, and economists have quickly lowered the growth forecast after the shocking GDP release on Friday. And they will quickly be looking at the RBI's expectations on inflation and growth, which they will release during their MPC meeting. That's it from us today. Thanks for listening. Tune in tomorrow for the latest in the financial markets.